January 29th, 2026. Thursday morning. Markets open in Tokyo, and within 90 seconds, the Nikkei is down 4%. Hong Kong follows. Then Singapore. By the time London wakes up, European banks are in freefall. And when New York opens, Microsoft loses $357 billion in a single trading session. That's the entire value of Netflix, gone in 6 hours. Financial commentators called it a correction. Analysts blamed profit-taking. The Federal Reserve issued calming statements about market stability and temporary volatility. But they were all lying, either to you or to themselves. Because what happened between Wednesday morning and Saturday afternoon wasn't a market correction. It was a margin call on an empire, and the ledger just came due. We think nations fall because of wars, because of revolutions, because of charismatic leaders making catastrophic decisions on battlefields. That's the story they teach in schools. That's the narrative that makes history feel dramatic and human. But it's fiction. Nations don't collapse because generals lose battles. They collapse because accountants run out of columns, because the numbers stop working, because at some point, the math becomes so grotesque, so impossibly unbalanced, that confidence shatters like glass. And when confidence breaks, everything built on top of it comes down, not slowly, violently. The United States entered 2026 as the undisputed financial superpower of the planet. The dollar was the reserve currency for 70% of global trade. Every barrel of oil, every international transaction, every central bank vault was stuffed with American Treasury bonds. The system was built on a simple premise. America pays its debts. America is stable. The dollar is eternal. For 80 years, that faith held. But faith is not a financial instrument. Faith is a psychological state, and psychology can flip in 36 hours. Let me show you the foundation everyone thought was solid. Picture the American economy at the start of 2026. The stock market had been climbing for 15 months straight. Tech companies were valued in the trillions. Unemployment sat below 4%. Consumer spending remained robust. The surface looked pristine, polished, indestructible. Beneath that surface, the ledger told a different story. The national debt had crossed $38.43 trillion on January 7th. That number is almost impossible to comprehend, so let me translate it into something visceral. The United States was borrowing $8 billion every single day just to keep the lights on. Not to build infrastructure, not to fund innovation, just to service existing obligations and pay interest on previous borrowing. Interest payments alone consumed $1.2 trillion in fiscal year 2025. Think about what that means. America now spends more money paying interest to bondholders than it spends on Medicare, more than it spends on the entire defense budget. The country had become a debtor working 3 jobs just to make minimum payments on maxed-out credit cards. And the creditors were starting to notice. Here's where the addiction became lethal. For decades, the United States could borrow without consequence because it controlled the reserve currency. When you print the money the world uses, you can export your inflation. You can borrow in your own currency and watch other nations absorb the consequences. It's the perfect scam, the ultimate financial privilege. But that privilege depends entirely on one thing: the belief that you'll eventually balance the books. That belief was dying, and this week it started hemorrhaging. Wednesday, January 28th. The Federal Reserve held its first policy meeting of the year. Markets expected rate cuts. For months, the Fed had been signaling it would ease monetary policy to support growth. Inflation was supposedly under control. Analysts had priced in at least a quarter-point reduction. Instead, the Fed paused. No cuts. The official statement cited persistent inflation and stubborn labor costs. But that wasn't the real story. The real story happened in the 15 minutes after the announcement. The Trump administration issued a public statement questioning Federal Reserve independence. An investigation into Fed Chair Jerome Powell was announced. Political pressure for immediate rate cuts became explicit and aggressive. Financial markets have seen political theater before. They've weathered government shutdowns and budget standoffs. But this was different. This was the executive branch of the United States government, openly threatening the central bank's autonomy. And autonomy is the only thing that makes a central bank credible. Without independence, a central bank becomes a political tool. And political tools print money to win elections. When that happens, currency dies. The bond market understood this immediately. 10-year Treasury yield spiked to 4.3%. 30-year bonds hit levels not seen since September. The market was repricing risk, not the risk of default, the risk of debasement. Thursday, January 29th. The avalanche begins in Asia. Tokyo opens down 6%. Within an hour, the Nikkei has lost 9%. Hong Kong follows with an 8% collapse. These aren't Western markets reacting to American news. These are the creditors panicking. Japan holds over $1 trillion in U.S. Treasury securities. China holds another $800 billion. When the Fed's independence gets questioned, those holdings become toxic. Because if America starts printing money to satisfy political demands, every dollar-denominated asset loses purchasing power. The debt doesn't disappear. It gets inflated away. And the creditors eat the loss. By the time Europe wakes up, the contagion is unstoppable. A major European financial institution announces it's unwinding $35 billion in U.S. Treasury positions. They don't bury this in a quarterly report. They issue a public statement. They explicitly cite unsustainable fiscal trajectory and political dysfunction as reasons for divestment. Read that again. A major European bank just publicly stated that American debt is unsustainable. This is the financial equivalent of a doctor telling a patient they have 6 months to live. It's not speculation, it's diagnosis. When U.S. markets open, the circuit breakers trigger before the opening bell even rings. Futures are limit down. Trading halts kick in automatically. When the market finally opens, it's carnage. Microsoft drops 10% on cloud revenue concerns. But that's just the headline the media can understand. The real story is happening in the Treasury market. Yields are spiking despite the Fed buying bonds. The intervention isn't working. The central bank has lost control of the yield curve. That's the smoking gun. That's insolvency showing its face. And then gold does something extraordinary. The metal hits $5,680 per ounce, the highest price in recorded human history. This isn't speculation or momentum trading. This is capital fleeing paper assets for physical metal. This is the market screaming that currency is dying. For 18 hours, gold climbs relentlessly. Every dip gets bought immediately. The message is clear. People with serious money are abandoning faith in dollars. But then the margin calls start. The CME Group, which runs the futures exchanges, raises margin requirements on precious metals by 40%. Leveraged traders suddenly need to post billions in additional collateral. They don't have it. Forced liquidation begins. Silver collapses 12% in under an hour. Gold crashes from its peak, losing $500 in 90 minutes. Financial media immediately spins this as bubble bursting or speculative excess correcting. But that's not what happened. The fundamentals didn't change. The loss of confidence in currency didn't reverse. What happened was leverage unwinding. Traders were forced to sell the only liquid assets they had to meet margin calls. It's a mechanical liquidation, not a change in sentiment. And that makes it even more dangerous, because the underlying driver, the flight from currency to hard assets, is still accelerating. Friday, January 30th. The liquidation spreads like a virus through every connected market. Bitcoin falls below $80,000. Ethereum drops under $3,000. Crypto holders are dumping to cover losses in traditional markets. Stock index futures gap down another 4%. The correlation across all asset classes goes to 1. Everything falls together. And when everything falls together, it means the problem isn't individual assets. It's the system itself. It's the denominator. It's faith in the currency that prices everything. The dollar falls 3% against major currencies in 48 hours. For a reserve currency, that's not volatility. That's a crisis. Currency traders start positioning for sustained dollar weakness. Not in 6 months. Now. The Forex market is the largest and most liquid market on Earth. $5 trillion trades every day. When that market turns against a currency, central banks can't stop it. They can intervene. They can burn through reserves. But they can't reverse a genuine loss of confidence. And confidence is breaking in real time. Let me show you the pattern. Because this isn't the first time a reserve currency has died. It's happened 17 times in recorded history. Rome, Spain, the Dutch, the British. Every single dominant empire that controlled global trade eventually debased its currency and lost reserve status. The pattern is identical every time. 4 stages, predictable, documented, unstoppable. Stage 1 is earned dominance, real productivity, military strength. Sound money backed by something tangible. The currency works because it represents genuine value. Everyone wants it. Trade flows through it. This stage can last centuries. Rome had it for 200 years. Britain had it for a century. America had it from 1944 to 1971. Real dominance built on real production. Stage 2 is the seduction. The empire realizes it controls the global currency, so it starts creating more of it to fund things it can't afford through taxation. Wars, social programs, political promises. The gap between revenue and spending becomes permanent. But because they control the reserve currency, they export the inflation. Other nations absorb the excess money supply. The consequences get delayed. Stage 2 feels like prosperity. It's actually the beginning of insolvency. Stage 3 is the crisis. The math becomes impossible to ignore. The debt can't be paid. Not difficult to pay. Mathematically, impossible. Foreign creditors start questioning whether they want to hold reserves in a currency being systematically destroyed. Confidence cracks, not all at once, in waves. A bank here, a central bank statement there, then suddenly, violently, triggered by something that seems unrelated. A policy announcement, a political crisis, a market shock that reveals the fragility underneath. We just entered stage 3 this week. The cracks are visible now. Stage 4 is the reset. The system breaks. The currency either hyperinflates or gets replaced entirely. Reserve status shifts to a new power or new system. Wealth transfers from those holding old denominator assets to those positioned in the new reality. This stage is brutal, fast, irreversible, and it's coming. Let me prove this with numbers you can verify. Rome's denarius contained 98% silver under Augustus. Real money, real value. By the time Nero started debasing it in 64 AD, silver content dropped to 90%. Still high, still trusted. But the precedent was set. By Caracalla, it was 50%. By Claudius II in 269 AD, the silver content was 2%. 2% from 98% in 200 years. Prices exploded. A measure of wheat that cost 1 denarius in the year 200 cost over 200 denarii by 270. The currency died. The empire followed. Weimar Germany in 1921 had an exchange rate of 60 marks to $1. Concerning but manageable. By November 1922, it was 7,000 marks to the dollar. By August 1923, 1 million marks to the dollar. By November 1923, 4.2 trillion marks to the dollar. Workers were paid twice daily because money lost half its value by afternoon. People carried wheelbarrows of cash to buy bread. A lifetime of savings couldn't purchase a week's groceries. The currency didn't decline. It evaporated. The British pound was worth $4.86 in 1939. By 1949, Britain was forced to devalue by 30% overnight. By 1967, another 14% devaluation. The pound that had been the global reserve for over a century was worth $2.40. Reserve status transferred to the dollar. Britain went from empire to IMF bailout recipient in 30 years. The pattern completed again. Now look at America. The national debt in 1971 was $370 billion. Manageable, reasonable. Today it's $38.43 trillion. A 100-fold increase in 54 years. We've added more debt in the last 15 years than in the previous 224 years of American history combined. The interest payments alone exceed $1 trillion annually. We're borrowing money to pay interest on money we already borrowed. That's not a sustainable fiscal policy. That's a Ponzi scheme in its terminal phase. And this week, the creditors started walking away. China reduced Treasury holdings by $120 billion in January, the largest single-month decline ever recorded. Japan's parliament is debating reserve diversification. Saudi Arabia is negotiating oil sales in yuan instead of dollars. These aren't random events. These are creditors reading the ledger and deciding the risk is too high. When creditors lose faith, the game is over. Not eventually. Immediately. Here's what people don't understand about currency collapse. Wealth doesn't disappear. It transfers. In Rome, wealth held in debased denarii evaporated. But wealth held in land survived. Productive estates maintained value. In Weimar, cash holders were annihilated. But real estate owners saw property values skyrocket in nominal terms. Business owners survived. Foreign currency holders multiplied their purchasing power. In Britain, those who moved wealth to American equities and dollars built generational fortunes, while sterling holders lost 70% of purchasing power over 3 decades. The pattern is consistent across every collapse. Wealth moves from paper assets to real assets, from currency to commodities, from promises to production, and it happens fast, violently, without warning for those who aren't watching. But the signals are always there, always visible for those who know what to look for. And this week, every single signal lit up red. Signal 1. Foreign creditors dumping sovereign debt. Check. China's reduction is unprecedented. European institutions are publicly questioning holdings. This is capital flight at the sovereign level. Signal 2. Central bank losing control of interest rates. Check. The Fed bought bonds aggressively Thursday and Friday. Yields spiked anyway. When intervention fails, credibility dies. Signal 3. Flight to hard assets despite intervention. Gold hit all-time highs. The crash was forced liquidation, not loss of confidence. The underlying demand for non-currency assets is accelerating. Signal 4. Political paralysis, preventing solutions. Congress is deadlocked on debt ceiling negotiations again. The White House and congressional leadership can't agree on basic fiscal frameworks. The political system is incapable of addressing the structural problem. The debt keeps growing. The borrowing continues. The math gets worse daily. Signal 5. Mainstream denial. Every financial network called this a healthy correction, a buying opportunity. Exactly what they said in 1929. Exactly what they said in 2008. The denial is part of the pattern. Saturday, January 31st. Markets are closed, but the damage is done. $7 trillion in market value wiped out in 36 hours. But that number is almost meaningless. Because the real story isn't the nominal loss. The real story is what that loss reveals. It reveals that the foundation everyone thought was solid is actually hollow. That the empire everyone thought was eternal is actually insolvent. That the currency everyone thought was stable is actually dying. Think about the scale of what just happened. In 1 week, the United States lost more market value than the entire GDP of Germany. Gold hit record highs. The dollar fell 3%. Foreign creditors started dumping treasuries. The Fed lost control of yields. And mainstream analysts are still calling this temporary volatility. That's not analysis. That's wishful thinking. That's denial in the face of mathematical reality. Here's the truth they won't tell you. Sovereignty is solvency. A nation that can't pay its debts isn't sovereign. It's a debtor. And debtors don't make their own rules. Creditors do. America is about to learn what Britain learned in the 1970s. What Rome learned in the 3rd century, what every empire learns when the ledger comes due. You can have the strongest military, the best universities, the most advanced technology. None of it matters if you can't balance the books. Because wars are fought with money. Innovation requires capital. Power requires solvency. And America is insolvent. The debt is $38 trillion and growing $8 billion per day. Interest costs exceed 1 trillion annually. The political system is paralyzed. The Federal Reserve is losing independence. Foreign creditors are fleeing. The currency is weakening despite intervention. Every single characteristic of Stage 3 is present and active right now, which means Stage 4 is coming. Not in a decade. Not in 5 years. Soon. Possibly within months. When Stage 4 arrives, the wealth transfer will be the largest in human history. Trillions will move from dollar-denominated assets to hard assets, from paper promises to physical goods, from those who trusted institutions to those who studied history. The only question that matters is which side of that transfer you'll be on. Will you be holding cash and bonds denominated in a dying currency? Or will you own land and gold and productive assets with value independent of paper money? This isn't about politics. This isn't about left or right. This is about mathematics, about patterns that have repeated across 26 centuries of recorded history, about ledgers that always, eventually balance, not through policy, through collapse. The empire had a choice decades ago. It could have lived within its means. It could have maintained sound money. It could have preserved the trust that gave it reserve currency status. It chose differently. It chose to borrow, to print, to debase, to export inflation and delay consequences. And now the consequences are here. $7 trillion evaporated this week. But that's just the beginning. That's just the margin call, the foreclosure notice, the first crack in the dam. When the dam breaks, and it will break, the flood will be biblical. Currencies that took centuries to build can die in months. Ask Weimar. Reserve status that seemed permanent can vanish in a decade. Ask Britain. Empires that appeared invincible can collapse when the money runs out. Ask Rome. The pattern is here, active, accelerating. And if you understand what you just witnessed this week, if you see the signals that everyone else is ignoring, then you have a choice to make. You can trust the institutions that created this disaster to somehow fix it. Or you can trust history, mathematics, the documented pattern of every empire that debased its currency and lost reserve status. Because the ledger doesn't lie. The ledger doesn't negotiate. The ledger always balances. And right now, the ledger is coming due. Subscribe to this channel if you want to stay ahead of what's coming. Because the transfer is happening, whether you're ready or not. The only question is whether you'll see it coming. History doesn't repeat. But the patterns do. And this pattern has never failed. Not once. Not ever. Be on the right side of it. Be on the